Alrighty, welcome to the OptionGenius show. Today is July 15th. My name is Alan Sama. I'm here with Matt. How you doing today, Matt?
I'm doing great. How are you?
I'm doing wonderful. Today we're going to be talking about debt.
Lots of it.
Not our debt, but there's a debt bomb that is waiting in the wings, you could say, for the for its chance to blow up. I mean, it's really a bomb. It's a ticking time bomb, actually, if it doesn't get reversed. And actually, it's going in the wrong way, um, in terms of individual investors and the big institutions. They're both in debt in terms of their trading, and chances are, if you're listening to this, you are also in the same shoes. I know I am. I am doing this, and I know a lot of other people that are trading are also doing this. And so we're going to talk about it, see how it could lead to a massive correction, and what you could do to protect yourself. So, I,
Got that off your chest there?
I hate it when it's like, bad news. It's like, oh man, give me a reason the market's going
I
to
don't
keep
know.
going up.
I don't say it's it's not bad news till it is, right? It's really kind of a warning, I
Yes.
would say.
Yes, it is
Tread
definitely a
tread
warning.
lightly, I would say. Be
Yes.
aware of what this is and, act accordingly.
Yeah. So taking a look at the today, what's going on in the markets? SPX up a little bit, Art's up 0.5%. Oil is at 79 after more attacks on Iran last night. Um, Gold is actually up. I'm surprised. And the Nasdaq is down, but overall it's pretty much a calm day. Banks had good earnings, and we're heading into earnings for everybody else. So this is earnings season, and all eyes are on the AI names and the mega cap tech names to see how much revenue they're generating from AI and if they're going to reduce their spend. If they reduce the amount of money that they are spending on AI, that is going to send markets much lower very quickly.
Yep.
Um, because of really what we're talking about today.
It's all interconnected.
It's all interconnected. And so I read this book, 1929, just came out. Forgot the guy's name, but he's a really good writer. He's been a writer for a while, and the book was actually very enlightening.
I was gonna say that's why I'm one of my on my list to read.
Yeah,
I have
yeah.
not ordered it yet, so don't spoil it. No, it's good though.
Oh, the market crashes at the end.
1929.
Uh, Kevin says, "Good afternoon from Lakeland, Florida. Wonderful to have you, Kevin." And then, yeah, so one of the things that I picked up there was at that time, debt was very bad. Most people did not go into debt. It was seen as a bad thing. There were no credit cards. There were no, you know, I mean, there were loans, but you basically maybe got a loan to buy a house. But there were no credit scores or
Oh, you went
credit
to the bank
credit
and they
reports.
would they would check your credit worthiness,
Well,
right?
they didn't know you. They didn't have credit back
Oh, yeah,
then,
they didn't
right?
know it,
So,
right?
so they're like, okay, do I know you? How long have you lived in this town? Do you have a good reputation? Do you have a good job? All that kind of stuff. And if they didn't like you, sorry, no loan for you. Um, but at that time, there was a banker who wanted people to buy stocks. He wanted people to open accounts with his bank. He wanted to, um, and I don't know, I don't remember if they made money on on the the stocks. I don't think they made like commissions, but he made it so that anybody could come in and borrow money to buy stock. And nowadays we have margin, which is similar, where you can borrow money to buy stock. Uh, at that time, if you put up $1, you could buy $10 worth of stock. That's what, 1,000% margin. Right? I mean, that's a lot. Well, you put up $1 and you can buy $10 because at the time the market was just going higher. And this guy thought, okay, this is a great way to get new customers to the bank. You know, they'll open accounts with me to get the loans, blah, 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 and we'll lend them money. And the market's going up anyway, so we'll be fine. And then when it wasn't, those people, they lost everything
Everything.
because, the stocks didn't even have to go to zero,
That's the key, right?
right? I mean, if you buy like a $10 stock, you buy one share of a $10 stock, you put up $1. Ooh, excuse me.
But-
You bought it on margin. If the stock goes down $1, that's your dollar that you lost, And the bank's going to be like, "Uh-oh, you need to put in another dollar, margin call." But the stock is already down 10%,
Right.
and you already getting a margin call. And so if it goes down 20%, like in the 29 crash, I mean, they fell 40-50%. They didn't go to zero, but they fell a lot. And so when they go down 40-50%, now you have to come up with five more dollars.
Right. And what time period, right? How
Yeah,
fast?
exactly. And so these were normal everyday people that were just trying to get rich. And so they didn't have a lot of backup. I mean, the dollar that they put up was like the only dollar that they had. Now, they might have had $100 or $1,000 or whatever. I'm just giving an example. But the money that they put up was all in. They didn't have money for margin calls because they were trying to get rich. And so we hear all the stories of 1929. Oh, people, people jumped out of buildings and this and that. Well, not too many people did that. There were some people that did that, but there weren't too many. But the majority of the people that got wiped out were small retail individual investors because they did not have the ability to hold on for things to get better.
Or even understand it.
Or yeah, even know what's going
I
on.
mean,
They
a lot
just,
of people
oh,
don't
it's going
understand.
up. I'm going to buy shares. I want to buy shares. And at that time, banks were one of the things that you bought shares in. So this banker was like, hey, yeah, this is great. I'm going to lend them money. I'm going to open more accounts and they're going to buy my share, my stock. So my stock is going to go up and I'm going to make more money. My net worth is going to go up and higher and higher. So it was perfect for him. And then other people started copying him. Other banks started copying him. And then it just became very common. They also had like bucket shops at the time, which is for people who could not even buy a share. And so he wanted people to get out of the bucket shops and to get into the actual market itself. So a bucket shop it's like a little storefront and it's like a bookie. You would go in and you would place a bet on a stock. You're not buying the stock, but you're betting that it's going to go up. And so whoever owns that bucket shop would be the bookie and it would take the other side. So you didn't have to
Like the
own.
early derivative.
Mhm, yeah, pretty much.
It pretty much is. I mean, it's the early
It's,
version of the
that's
derivative.
the early option.
I mean,
Yes.
that's all it is.
Yep, that's exactly what it was. And so he wanted people to get out of that and into actually the stock market. And so he lent them the money to do so. And obviously, yeah, that bank did not do well, but it wiped out a lot of people. And that's why a lot of people lost money because they were in debt. Um, After that, there was a lot of different reforms and whatnot, and so debt was wiped out, and then eventually they brought it back. And so now we have margin, but now margin is if you have a regular margin account, regular Reg T account, which is the normal one you sign up with, you get 50% margin. If you are somebody who has more money, I believe it's 125 at most brokerages right now, then you can apply for what's called portfolio margin, which is where they give you greater leverage because supposedly you know what you're doing just because you have more money. Now, when I opened it with Schwab, they did have a test, so I had to take a test. Um,
They're like, what is margin?
no, it was pretty difficult. Like there were some questions on there that I had no clue what the hell it was, and I
Well,
went
that's good
to.
to know.
Yeah, I mean, I went to AI and said, "Help me out here." And it's like whatever. It's just Don't let anybody from Schwab see this video.
Yeah, no.
But I got a
Talk about
perfect
your
score.
paper account.
I got a perfect score on that test. But yeah, that was them. Basically, they're covering their butts, right?
Yeah, that's all it is.
It's only if I lose money and I don't sue them. They're like, "Well, you took the test. You're a smart investor. You knew all this stuff." It's like, yeah, whatever. Um, but that is where we're at now. And the thing is that it's the limits are being pushed again. Like you have in other countries. So we don't have it here in the US yet, but these perpetual futures are basically a higher leveraged bet on a particular stock. These have been approved and they are coming. They are already here on like cryptos. So you can get not just 50% leverage like margin, but you can get 5x margin, 5x on crypto. In some crypto exchanges, you can get like 50 and 100 times, 100x. Uh, but those are unregulated, right? Um, and
And the
so
fine print, they're like, "Oh, you could lose all your money," and you're like, "Nah, don't worry about that."
you could lose, I mean, you could lose all your
Yeah.
money and then some.
Then some.
You could
Yeah.
lose 100 times all your money if you're that leveraged. You lose it
Hmm.
all. But then, so nowadays they have these new perpetual futures, and there's like Hyperliquid is one of the brokerages that's international, and they are offering like you could have, traded SpaceX before the IPO, even though the shares weren't even out yet. It was like again, like a bucket shop, like a derivative, pretty much,
Yep.
you know, and you could use it with margin and leverage and lots of leverage. So that's, when you look at it, like, okay, why does the market go down so fast? Markets, they go up slowly. They go up the stairs, right? What do they say? The bear, no, the bull goes up the stairs and the bull goes out the window.
Yeah. And Wall Street climbs the wall of worry.
Well, I don't think anybody's worrying anymore. If it's going up, ain't nobody's worrying. But when the bear market comes, the market goes down quick.
Accelerating, yes.
Why is that? Because of margin, and people are selling really quick. And if they don't sell, they are forced to sell, and that makes it go down even further because they're getting out at the wrong time, and
Yeah,
that
they're
pushes
forced to
things down.
sell at the wrong
So
times.
yeah, so there are margin calls that significantly impact, and you'll see this if we're in a down cycle, and you want to see this happening in real time. Look at the S&P, look at the indexes around the end of the day. There's a specific time when the margin calls go out to all the major brokerages from and the big institutions, and it's like, hey, you need to be out of these positions today, and this is for hedge funds and everybody, and you'll see a massive amount of selling. So you'll see the market just drop at that time because there's people that are having margin calls and they just sell, sell, sell. Um, and we had it in the Great Recession, 2008, 2009. There were days when the market, for no reason, would just be down like 6%. And then like the next day or the day after, people would find out, oh, it was because that big firm, they blew up. They had a
Hmm.
margin call, they couldn't satisfy it, so they had to sell everything on that day. And that's it took the whole market down with it.
So that happened. So that happened a couple years ago, right? With Silicon Valley Bank, I believe.
Yeah.
So there were like I think three banks, right? And it was just like a crazy selling day
Yep.
during
Yep.
this
I mean,
time.
it happens anytime there's a big change, and everybody tries to get out because everybody's margined up. And so they can't afford to lose money, right? And the loss just exponentially
Yeah,
grows. And
it's
so they have to
essentially
get out.
protect your butt day.
Yeah. Yeah, pretty much. Even if you don't like it. So, but right now, I'll let you take over from here. But right now, according to FINRA, we're sitting on a massive debt bomb that is very familiar to people who read this book, 1929, to people who lived in the Great Recession, right through that, or the dot-com bubble.
Yeah.
We had this same issue happen all three times.
Yeah. So it's saying that investors are now sitting on, as you said, on 1.42 trillion with a T of margin debt. So that's 8.5%, a jump of 8.5% in a single month of May. And it's almost up 54% from a year ago. So the margin levels are getting crazy.
And this is just individual traders, retail
Yes,
traders,
retail trading we're talking
small
about.
guys. Yeah.
And it goes here even further. It says um, margin debt relative to the size of the economy is running near 4% versus a 50-year normal closer to 1.5%. So that is a huge difference that we're
Hmm.
heading.
Yep. Like that's a 300% more than it normally is.
Now, I would go deeper and ask, why do you think that is?
Why is
You're
it?
talking about us taking all this margin. What would be the reasons?
I say it's because of all of this hoopla around AI. This is the new thing. This is going to change the world. You got to get on board. You're going to miss it. People remember the dot-com days. They remember the internet and they missed it. A lot of them. A lot of people missed it. And so now it's like, oh, this is bigger than the internet, dude. This is going to change everything. And it probably will. And so they're like, I need to get on board. I need
So
to get in.
you're thinking that we're in the euphoria part of the cycle.
Yeah, I think everybody wants to. So it's a big mix of stuff, right? So AI, they see it coming, they see it on the news, it's everywhere. They also see news about, oh, market reaching all-time high, all-time high, all-time high for the last 10 years or something. It just keeps going higher and higher. We have short-term dips, but then it just comes back up again.
And it's
And
going up on bad news.
it goes up on bad news and good news, you
Yeah.
know? And so people are like, okay, AI is coming. I might lose my job. AI is coming. I don't know what the future is going to be. Do my kids go to college? Is college going to be worth it? Do I have a job? Do I, is the government going to give me money to live on or not? Am I going to be poor? What the heck is happening? I can't buy a house right now. Everything is too expensive. My groceries are too expensive. I need help. And there ain't nobody to help me. So I got to have to help myself. And the only thing I understand is, hell, market's going up every day. Okay, let me go buy. And then,
I'm glad you said that because that's where I was interested. That's where I was thinking about it. I was thinking that people are they're feeling the pinch, everyday people, right? And we start to take outside risk, right? So we attach that to AI. You need to make a return. Need to get some movement in your portfolio. You need to move things along. So I think it's a confluence of those ideas.
yeah, I mean, we talked about this when there was the SpaceX IPO. We had people calling left and right. People calling me, hey, how do I get this IPO? How do I get this stock? How do I get this stock? I want to get in the stock market. And I was like, you hate the stock market. No, no, I want this one.
Yeah.
Out of the blue, everybody's interested now. So there are certain issues like that. AI is one of them. SpaceX was the IPO was another one, that people just gravitate and they open their accounts and they're like, yes, I want to do it. I want to do it. I want to do it. And then once they get involved, and there's also, now everybody's on their phone all the time. And with the betting, with all the prediction stuff,
Prediction
and
markets.
we had the football and then we had the World Cup, and there's everybody's betting on stuff. And so it's not a big jump to go from, okay, I'm going to bet on, how many goals is Messi going to score tomorrow versus, okay, I'm going to bet, if this stock is going to go up or not. So it's just a continuation of that. And it's the same
Yeah, so
thing.
there's less friction there for people to actually achieve this.
Yeah.
Yeah.
And so they're like, okay, I need to do something. I need help. I need money. Everything's getting more expensive, but what do I do? And then there's like, okay, I'll open this account and I bought this NVIDIA. Okay. You go to ChatGPT and you're like, what stock should I buy? And it'll tell you buy NVIDIA. That's like the first thing it tells you. Just buy NVIDIA. Okay. So people are buying Nvidia and it's slowly going up. And it's like, okay, how can I make it go faster? Oh, you can borrow money? Okay, I'll borrow money. Here you go. Go. Not
This,
only that, but then people find out there's a ETF that lets me do 2 times NVIDIA. Oh, okay, I'll get that instead. Oh, there's an ETF that does 3 times NVIDIA. Okay, I'll do that instead. And then I'll borrow money to do that. So I'll be like 6 times NVIDIA. Like, yay, I'm a genius.
here, 3 times up, 6 times down.
And so that's where we're at, right? And then not only that, but people don't have cash. That's the other thing that the report said that
Yep,
investors owe more against their accounts than they're holding in cash.
which is shocking.
Yeah. And so like we were talking about these leveraged ETFs, right? Since March, there has been $218 billion put into these leveraged ETFs. One of the biggest ones is SOXL, SOXL, the leveraged 3X. Um, and it has done incredibly well. Um, it has Micron and SanDisk. Both of them are like up thousands of percentage points in the last year. And so, if you had bought that, you did really well. And if you had margined it, you had done even better. But that's kind of where we're at now, that it just keeps growing and growing. People are waiting. Hope I don't know what if they're waiting, if they're taking profits or they're just waiting for it to
Most
go up and
likely
up and up.
not. I mean, if you think about people that are in these type of bets, they're greedy, so they're going to stay in it. So I
Yeah.
think
Yeah. I mean, the nothing has changed. The
no.
story is still the same, especially for the semiconductors. And so it's just a matter of time, you know. $50 billion went into semiconductor funds.
So I thought this was interesting. It said here, now we were talking about the big guys, right? Like Goldman and B of A and the Fed, and they're all warning about this, right? That it's too much debt. It's kind of funny that you're hearing about the Fed talk about there's too much debt. But it's like, really? Okay. But we've seen this end in what, 2000, 2007, and 2021. So this is we're, we're on the possibility, right, of this. We've seen this before.
So we're at record numbers of
Record number.
debt for retail traders. Right now, we're only talking about retail. We're going to move to the institutions next. But
Yeah.
yes, for retail traders, this is as much as we've ever borrowed. This is as much as, the more market money is in the market right now than ever before, and the margin is just incredible. Everybody's using it. And so I don't even know, and this only tracks, margin in the account. It doesn't track how many people have borrowed money to actually put into the stock market. Like, did you borrow on your credit card? Did you borrow on your home equity line of credit? Who knows? I don't
Yeah.
know. I haven't seen too much of that yet, hopefully. But I do remember in .com, oh, that was all over the place. .com people were like, yeah, I'm going to borrow on my mortgage. I'm going to borrow on my life insurance. I'm going to put every single dollar I can into the stock market, because it's like, oh, this time is different. This time is different. And we're hearing a lot of the same stuff and it's getting there. Um, so what, it's like they have the pyramid scheme, right?
Yeah.
You heard
The
of pyramid
MLM.
schemes, the
Yeah.
MLMs, and it's like, okay, you got to do one, and they do two, and they do three, but it's an upside down pyramid,
Yeah.
right? That's the risky one. If you have a regular size pyramid where you have like lots of layers at the bottom and then fewer layers and fewer layers, you're kind of protected. But if you're the upside down pyramid,
Yeah. It
then
hurts everybody.
that's when it comes crashing, it just buries you because you're the one guy at the bottom, right? And that's what it is when you borrow money. Um,
Yeah.
when you borrow the money because your stock is getting bigger, your account is getting bigger, but the margin is getting bigger and bigger and bigger and bigger. And when it falls, it's gonna
Big
crash.
diagram. You have like all that weight above your head and just
Yeah. So unless you actually take it out, which most people don't do because we don't know when to get out. That's the craziest thing in the market, right? When do we get out of here? When do we get out?
it can go for a while, way more longer than we ever think.
Yep.
right?
Yep. And so that's the situation. Um, and that is the risk. And it's not just individuals. It's not just, oh, the stupid retail trader. No, you know, currently there is something making the rounds through the hedge fund community, which is called the Treasury Cash Futures Trade. Treasury Cash Futures. So what is that? Well, this is kind of like when you hear asymmetric risk, you say like, okay, I can make $10 if I risk $1,
Mhm.
or no risk. Okay, how can you have no risk? Well, if you do arbitrage, right? It's like, hey, I'm buying this pen and I could buy it here for $1, but I could sell it to over there for $2. Well, then I have no risk because I'm buying it for $1 and selling it for two. Well, I guess technically, things would change, but really, that's what this is. So there's a small but persistent price discrepancy between the physical US Treasury bonds and the futures contract of the same Treasury bond. Now, they should have the same exact price, but they don't. So
Right.
one's a little bit skewed more. So if you buy the cheaper one and then you sell the more expensive one,
Make the
you
difference.
made the spread. Now, it might not be worth a lot, but as a hedge fund, you are able to go up to 10 times leverage or 30 times leverage. I mean, they get up there. And
Yeah, that can
so,
add up very quickly.
yeah, so if you have this small, like, okay, I can make 1% on this trade. Okay, great. 30 times leverage that. Oh, I'm now making 30% in a year, right? And it's still a very super, super safe trade because it's instantaneous. The second that I'm buying it, I'm selling it at the same time and I'm making the spread. So basically, they buy the physical bond in the cash market. And for options traders, that's kind of like the long leg, right?
Yep. Hmm.
That is furnished or financed with borrowed money because you can borrow money to do that, to buy treasuries. Anybody will give you money to buy treasuries. Then they short a futures contract on the same thing. So that's the short leg. That's the one they're selling, right? So it's like a spread. We're buying one, we're selling
Yeah,
one.
that's
Yep.
perfect.
And so when the futures contract expires, the price on both go to even, and the fund makes the money because
Leverage.
the bond is up here and the other one is a little bit higher. The futures is trading a little bit higher, and so it'll come down in price to match the bond. So it's pure arbitrage. Now, the danger comes from the leverage that they use to make it profitable. So there is also called the repo market, where this is where the money comes in. And we talked about 30 times. They can actually borrow up to 100 times for treasuries.
Yeah. That's,
Yeah. So, um, and then not only that, but what they can do is like, hey, I'm going to buy this treasury bond, right? I'm going to borrow money to buy the treasury bond. Okay. I'm going to sell the futures against it. So that trade is done. But I still own this treasury bond. So I go to bank number two. They're like, hey, bank number two, I have this treasury bond. I want to use it as collateral to buy more bonds. Oh, okay, sure. Here you go. Here's more money against your collateral. So they buy more treasury bonds. They short more futures. Then they go to bank number three and they're like, hey, I need more loan on this collateral. I have all these treasury bonds. So they just repeat the process over and over again. According to the Fed in June, their note confirmed that this trade has grown to roughly $830 billion.
oh boy.
And so the total amount borrowed from the repo market to finance this strategy is up to 1.8 trillion. That's how much they've borrowed. 1.8 trillion. So we talked about FINRA talking about retail traders at what was it? 1.4 trillion?
1.4.
Yeah.
1.42.
1.42 trillion that retail traders have borrowed. And then now on this side, you have institutions that have borrowed 1.8 trillion dollars. So put that together, and that is not just 4% of the US GDP, that's like almost 9% of the entire economy. It is just borrowed for these two trades, long AI and this futures spread.
Wow.
So
That puts it
that
in perspective.
that is freaking crazy. So, I mean, it's great when this trade works, right? But when it doesn't, it goes. So we all remember COVID, right? And the COVID crash.
Hmm.
I think the market, it took like less than a week to drop 20%. This happened also during that time. And the institutions, to raise money for this treasury thing, they had to sell everything. So this is a trade that they continue to do. As long as it works, they keep doing it. But then eventually it stops working and then they have to unwind it. And that's where the problem comes in because they've borrowed so much money. Right now, today, this trade is double the size it was in March 2020.
Ah, ah.
So if something that required the market to sell off happened, it would generate double the forced selling pressure that we saw in the treasury market during COVID.
That's gonna be, so I think of like circuit breakers, that type of thing.
Yeah. Uh-huh.
If, yeah, well, definitely would be circuit breakers.
Mm-hmm. Yep. Definitely. So
There's usually some kind of catalyst though that would tip these type of events off.
it'll have to be a catalyst, but I think the catalyst could also be the AI trade. If things slow down, we could go. I mean, if Nvidia comes out and says, "Hey, you know what? Our margins are no longer 80%, now they're down to 60%."
Well, it was interesting that today, or was it yesterday, with JP Morgan, they had their best quarter ever,
Mm-hmm.
and yet their stock's going down because of warning about the debt that we're talking about.
Mm-hmm. Yep. Um, a lot of their money they're making from trading,
Hmm.
and they're also leveraged. You know, we're not even talking about how much leverage they have. We're just talking about for institutions. We're only talking about one
Well,
trade.
even like you said, even the debt that we know about, right? There's layer and layers of debt that we don't know about.
Yeah. And so, if something happens and these institutions they start selling off, because once they have to start selling, they're going to get out of the futures, but they have to sell their treasuries, right? Because they own the treasury bond. So they have to sell that. So that's going to put a lot of selling pressure on all of these treasuries. That's supposed to be like the safest thing out there. So that's going to send rates higher
Right.
because if you want me to buy your treasury bond, I need more interest. So
Taking
rates are
more
going to
risk.
go up. That's going to lead the stock market to go down, right? That's going to take that 1.4 trillion that we've all borrowed. We're going to be having margin calls. So that's going to cause us to start selling our stocks. And that's going to send it even further down. So you have treasuries going down, then you have the stock market going down. You have the entire global system going down because
Right. And you're
everything
talking
is
about austerity that's needed to make this happen, right? There's got to be some pain that we have to endure for it to even get down to a regular level, which I argue that nobody's willing to take. That's why you have government step in
uh,
and print money.
yeah, that's the only thing
They
they
don't have
have.
any choice.
They don't have reserves. They don't have, the government is full of debt themselves. We're talking about a debt bomb, but we didn't even mention the government debt bomb. So what are they going to do? They're going
So
to
when the Fed comes out and they're like, "Oh yeah, we're going to raise the rates for, a quarter point," I don't know if that's really going to do much. Not on
that's
something
not
like this.
that's not going to help.
No, it's not.
That is going to push the market um more into this tipping point where it's
Yeah.
going to tip over. It's looking for something bad. It's looking for a bad catalyst. Until then, everybody's just like eyes closed. Yeah, 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 yeah. Market
That's
going
where we are.
higher. AI is wonderful. Robots are gonna do my laundry. Everybody's happy. But once that one thing clicks, it all could go down very, very fast. And so that's why, I mean, this topic I don't like at all, but we got to talk about it because I don't hear nobody else talk about this. And
No.
I saw this headline cross when you showed it to me, and I was like, whoa, that's bad. Because then the first thing I did was I looked at my account. I'm like, oh, yeah, I'm using too much margin myself.
Yeah, not only
Yeah.
that, you have to watch the margin, but like how do you position yourself, right? And a lot of it is you're not using margin, number one, not as much. You're being very cognizant of how much margin you're using.
Hmm.
I'd also say that with us being option sellers, we're selling time, which is a lot better than being on the buying end of things. So there's also, you have to think about hedges and what you would do to protect your portfolio, I would say,
Hmm. Yep.
because that
Yep.
day is going to come. I mean, we all know it, right? So
That day's gonna come. It's time to be more cognizant of that. And I don't think any asset will be spared. So if you think, oh yeah, I'm gonna go buy everything in gold, or I'm gonna go buy in crypto, or I'm gonna go buy real estate, I don't think anything's gonna be spared. I think it's all going down.
yeah, I think of like Ray Dalio, right? He's has that all-weather fund where it's like, okay, he's spread amongst many different things. Yes, it's a diversification, but you're more likely not to take a full brunt unless you're in, the one asset class. You're not going to get completely wiped.
But it doesn't mean it can't go down. It's still gonna go
No, you
down.
can, but it's all about like margin, like you said. You want to be able to weather that situation the best you can, right? So you don't want to be like what's said here that there's one, oh, who was it? Went down 31% in one day. One day.
That was the
Yeah.
ETF, yeah.
The ETF in one day, one single session. I mean, that's just
Okay, so
outrageous.
I gotta push back on that one.
Yeah.
That sounds crazy. That's the SOXL that we were
Yeah. I
talking
mean,
about.
that's if you were in that one.
Yeah. Okay, but it was down. Yes, it was down 31% in one day. Okay. And so at the end of that day, it was still higher than it was 2 weeks before.
Right. So we're talking about like, oh, a small little falling dagger amongst the left to right
Yeah.
chart. Yeah.
So it lost 2 weeks worth of growth in 30% in one day.
So it's still in a bull run.
And 2 weeks later, it was up another 100%.
Yeah.
It got the whole 30% back and it kept going 2 weeks later. So again, if you had just closed your eyes, you would have missed it, right? Da, 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 da. Oh, it's down today. Okay, no, it's okay. You'll be up tomorrow. And it was. And it just kept
It
going.
is a warning. It is a warning to the margin that you are in.
So, yeah, but you have to be able to handle that type of move,
Right.
right? If you cannot, then you should not be in a triple leverage ETF.
But it looks like
Because,
a lot of people are.
but it looks like everybody is.
That's what I'm saying.
Everybody's moving to these triple leverage ETFs. And there are there are not that many stocks that are IPOing. The IPOs get headlines. They go, this company is going public, this company is going public. And yeah, there are a few companies that are going public right now because the market is so hot. But there are many, many more ETFs that are coming online, especially this year. So we had 2025 was like a banner year for ETFs. This year in June, since in the first 6 months, we've already had more than all of last year. New ETFs coming on board. And so, we just had some stock that went public. What was it? Nebius or something?
Mhm.
We were talking about it. Uh, like a week later, they already have, 2x Nebius and 3x Nebius. and then 2x on the short side and 3x on the short side as well. So if you want to bet up or down, you have leverage ETFs. So every stock has like four ETFs for it.
So what we're really talking about is like when does this stop or how does this stop?
Like yeah, it's getting
I,
crazy.
yeah. So watch out below, huh?
Eventually, yes. And it's like, the only people making money are the people that come up with all these ETFs.
It's like
And it's
everyone's in the theater and we're all going to look for the exit. So
ex
it's
that's exactly how it is.
exactly
Somebody
what it is.
somebody's going to yell fire. Maybe there is a fire or maybe there's not a fire. But if people start pushing and
You stampede
panicking,
exit.
then everybody starts panicking. And because of the margin, we've seen this happen. Like it's not like we've never happened before. This is the normal trend, you know? The subprime mortgage market, why did it go down so bad? Because everybody was borrowing money that they didn't have, they couldn't afford. So, like in that Big Short movie, right? It was like, oh yeah, the strippers have like 10 houses.
There's a
It's like,
bubble. There's a bubble. There's a bubble.
yeah. Like, okay, right? If one person owns 10 rental houses and they don't know anything about it, then yeah, probably there's something going on here. Um, and so when you start talking to your friends, normal people, and they're talking about, leveraged ETFs, that's kind of the same thing here.
Yeah.
So, um, I had a friend come up to me. He goes, "Oh, my son told me to bought Marvell."
Uh-oh.
And I'm like, I don't even know what Marvel does. I
Yeah.
know you're not talking about the comic books, right? He goes, no, no, no. There's a AI stock, Marvel, and I'm like, I'm not sure what they do, but the fact that you know that name is scary to me. Because yes, I think they're building data centers or something like that. They have something to do with the AI name, and they've been doing well. So I've seen the ticker around. I don't know exactly what they do, but it's like
MRV, yeah.
It's like your son, who's like 19, college dropout, is telling you to buy this?
And then Alan went home very slowly and started buying puts on the market.
No, I still have it. But there's one thing that we've seen. Okay, so there's one thing that we've seen, and this is for everybody. Like the market is not going to drop like that.
No, you
we're
always
not,
said this. I love this. I
yeah.
really do
So
think this is very true. It's
we're
great.
not going to wake up one night and have the market down 10, 12, 15%. It doesn't happen that way. There is always, and you can go back and look at all the charts for every major drop, even COVID. There's always a smaller drop that came out of nowhere. Nobody was expecting it. No, nothing happened. There was really no big news. Maybe a little bit something, but the market was down, like 4 or 5% in a couple of days. And everybody was like, "Oh, what happened?"
Yeah, it's
And it's like,
searching. Like,
"Is this
huh.
the end? Is this the end?" And then it stops. And then it calms down. It might even go back up again, but then it just goes sideways. And people are like, oh, that's over with. Oh, we're done. We're done. It's okay. That was nothing. It's no big deal. And they start saying, oh, it's da, 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 da. And then the market starts dropping. Boop, 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 boop. And then it goes down. So you will always see a big, relatively big for that time drop before you have the massive fall. And you got to look at the standard deviations, like how much is the average S&P moving in a day? Is it 1%? Is it 2%? All of a sudden it starts moving 2, 3, 4, 5% a day. Okay, something is going on. We need to back out,
You
right?
get silence.
Yeah, so that's why, that 31% drop for that ETF, it makes headlines. It's like, oh, down 31% a day. Yeah, but
In what context? Yeah.
yeah, I mean, it goes up and down 10%, 12, 15% every day. So that's not a big deal. That's a 2-day move, right? Now, if we're talking about Walmart, oh, Walmart down 30%. That's really bad. So
Yeah.
you got to look at the context too of all this freaking news. And so the market keeps heading up higher. It's rolling. The earnings are supposed to be really good this earnings season. So far, the banks are doing great. Um, the the Microns and the SanDisks, the ones that have gone up so much, they have started to pull back. And I saw a post on Twitter yesterday that, oh, hedge funds are getting back into the memory names. Like, oh, because they dropped for 2 or 3 days in a row, and then a couple of days they started going back up again. So it's like, oh, hedge funds are getting back in. Look at this data, blah, 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 blah. Well, what are they doing today? SanDisk is down 8.5%.
Yeah, there's a lot of profit taking and rotations and other things.
Mm-hmm.
You're not always going to have a 10 and 20 bagger. It's just not possible. So I mean, I get there's natural rhythms to the market.
Yeah. In the meantime,
Mhm.
um, you take a look at some of our past shows, and we've actually been doing really well in highlighting what's going on and what people should be investing in. Even though this show is only for education and entertainment, we're not telling you what to invest in, we're not giving you advice, but some of the stuff that we've highlighted is doing really well. The Canadian banks that we talked about are still on fire.
Mhm.
They might be better performing than any other sector right now that I've seen. I'm looking at it and I'm like, every day it just goes up and up and up. It's like quietly, silently.
Those are the ones. Those are
It's
the ones you love.
yeah, I mean, I bought one of them and it causes me no stress. Like it just goes up every day. It doesn't go up 10%. It goes up 0.5%, 1/4%, but it's like creeping higher. Troot, 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 troot. Like I love this. It took a while for it to start getting momentum, but now it's like, okay, maybe I should just sell everything else and just buy this.
See, making money boring is sexy.
It's supposed to be boring. It is
It's
supposed to be
supposed to
boring.
be. Yeah.
This trade that we talked about, the treasury arbitrage, is a boring trade. It's a almost risk-free trade because of what you're doing. And that's what they're all going into. And if you can make money that way, why would you risk trying to pick stocks or anything else?
Well, that's what they do with the Japanese carry trade.
That's exactly the same
Exactly what
thing.
they're doing. They're making the spread and they've been doing it for years, like decades.
Mm-hmm.
So when that unwinds,
Yep. We
and
had
that
we
that's
had a
secretly an issue now.
Yeah, because everybody's like, oh, the yen keeps getting weaker and weaker and weaker, and what is Japan going to do? They have to step in and help their currency. So far, they haven't done anything. Last week, or was it this week or last week? I'm not sure, but they came out and they're telling, locals and they're telling their banks and their companies to buy their own stocks. Like, hey, buy Japanese stocks. You know, send the is help the Japanese yen recover. Um,
Right, but we don't want the money being pulled out of the US market and then, it's all connected.
yeah.
Uh, uh, yeah.
So I wish I could have more clarity and be like, yes, this is going to happen on this day, and we need to be
No,
out of the
we all
market by
do. We
then.
all
But
do. But you have to be cognizant of the warning signs, and there are plenty.
yeah, and these are too huge, and we I mean,
But you are in control of common sense, right? You can see these things happening. It's happened again. It's repeatable. Um, so we shouldn't be utterly surprised when it does happen.
right. Mm-hmm.
Are you
Yep.
going to pick the exact day? No.
Right. So I mean, that's why, like, we go back to, if you're selling naked puts, right? In this market, it's been doing really well for the last several years. It's been doing really, really well. But if you're doing it on stocks that you have no clue what they do, or they're not stable, they're not normal passive trading stocks that are going to be around for 100 years, you might be holding the bag on something that goes out of business because all of these names are not going to survive this AI. When the AI apocalypse, the AI bubble pops,
Especially now, yeah, especially in this age.
there's going to be a lot of companies that go out of business. All these data center companies, all these energy companies, all this stuff that's coming up, these little IPOs are happening. All of them are not going to be around.
Well, let's be real.
So,
It's a race. So they're all spending and they're all trying to be number one.
hmm
Uh,
yep. And this pushback um, about data centers and where they're going to go is something to really keep an eye on as well. Because without the data center, the AI cannot advance.
Need the infrastructure. Yeah.
Exactly. And so, New York, I just believe they just banned data centers. Like they don't want them. The state was like, yeah, we're not building any in New York.
It's
And
such a
other,
touchy thing too, because you don't want to fall behind China, and all this. And then um, it's very interesting this week. I was reading about how China is through distillation, basically they steal the information on some of these frontier models that the US has. So it's like, okay, we're spending all this money to have these frontier models, and they can do it just like back when DeepSeek happened, right? So it's like they have 80% of the model, and they have it, just so much cheaper. So we're in this weird period right now. We're trying to win, and there's a lot of money being spent, and who's going to be the winner?
I think it's a game that, yeah, I don't know. I have no clue
Yeah, it's got
who's
to
going
play
to be
out
the
though.
winner.
But there's going to be obviously there are going to be winners, and you have to be aware of that there are going to be losers as well. So,
hmm So we'll see what happens. Um, and we'll keep an eye out for all of the big Mag Tech or Mag 7, Mag 10, whatever they are, to see how much they're going to be spending. And that's going to be the next catalyst. So if they come out and if they say, hey, we're spending more money, then the AI trade continues. If they say we're spending less money, that might be the first, 3-4% drop that we see, the little mini drop.
yeah,
So,
they talked about that, like who's the first one that pulls back, and everyone's like, "Good job."
but
In a
that'll
way,
send everything down.
everything, because
That'll
everything's
send them
going to
all
fall. Yeah,
down. So they won't get, whoever says it, they're not going to be rewarded. They're going to sell off big, and then the rest of the AI names
we'll
will sell off
follow.
too. Yeah.
Yeah.
So, okay. Well, that's it for today. On that note,
No, it's good that I like that we're talking about this because a lot of people do not. They
it's
really
not it's not the end of the world yet, but we're seeing the signs, and it's
Well,
good.
you have to, that's the best thing. You have to see they're all patterns, right? We know that history is repeatable. It's going to repeat mostly in the same things. May not be exact, but it'll rhyme.
Mm-hmm.
You just have to be awake, right? And you don't want to be putting your head in the sand, right? Especially with money you don't have. Margin.
Especially if you're borrowing money, yes, which
All right,
we all,
sorry.
it seems like we all are.
Yeah.
And so yeah, so you got to be careful. But it's time to be more nimble, I think. Unless you're investing for the very long term, then, you know, have some cash ready when
And
this stuff
you're
drops.
going to be excited I mean, of course, you don't want the economy going down and you don't want all this hardship, but if you have some cash in your position, you're going to be ready for it, right? To take advantage of it.
And that's the hardest time. That's it's like the
The hardest
market's
time.
down. It's like, I don't know. Well, it's like I might lose my job. My business might go under. I have this money, but I might need it. So I don't want to put it in the market right now, even though the market is down 50%. I don't want to put it in the market right now because I might need it. So,
Well, I mean, if you can ahead of time try to earmark that for that specific situation, then when the time comes, you're more apt to take advantage of it rather than pull it
hmm yeah.
for survival.
Yeah, I mean one area or one place to do that, and I don't know. We're getting into more borrowing money in this situation, but um, life insurance, like whole life insurance, if you have a whole life policy and you haven't borrowed from it, if it's set up properly, um, that could be an answer. Right now, the whole policies that we have, if we borrowed the money out, we're paying about 4.5% interest, and the policy pays us 5%. So it's like even if we don't make a payment, the policy can pay for the loan,
Very
which
nice.
is which is really weird.
Nice little
But
arbitrage there.
yeah, I was
Yeah.
right there. And so
Yeah.
that's what I'm doing that right now. So I opened a new one for my wife. Um and We have our old policies, so I'm borrowing from those old policies at 5%. Those are older, so I think it's like 5.5% interest on
Hmm.
those. And I'm going to take that money and feed it into the new policy. So the new policy has let's say, I don't know, 100,000. So we borrow from here and then we'll put it in here. Now that policy is also making money because what happens is when you borrow the money, the insurance company lets you borrow the money. It's not your money that you're borrowing. So your money is still in the account and it's still growing. So like if I borrow 100,000, my 100,000 is still there and it's still growing at 5%.
Right.
But my interest is 5.5. I'm still losing, 0.5%. But it's like a 0.5% interest loan, pretty much. Right. So
Hmm.
now I'm going to take that 100,000 and I'm putting it into the new policy. And because it's a new policy, I can borrow at 4.5%, which I don't know why, but it's different. And so I'm thinking, okay, what if I just borrow that 100,000 back out and put it into something that's paying me like 10%? So
Yeah. And
whatever money I make on that 10%, I could just use that to pay both policies off. And so I get one policy basically for free. And then when the debt's paid off, then I have the money just sitting there. And I'm
Banker Allen, look at you.
so it's like, yeah, it's like what? So that's one of
It's
the
all just
areas.
numbers. I mean, you're just moving our money around to
Hmm.
10%.
Yeah. So I was thinking about doing that. Um, or maybe taking it out and putting it into market power automation, which is doing really well. That's going to make a
Speaking
lot more
of,
than
are you
10%.
gonna? Yep.
So
Speaking
speaking
of,
speaking of that, I'm ready for our presentation tonight. We will be introducing, uh, I guess, I don't know, I'm not sure what it's called, market power automation or market power autopilot, I guess. I don't know. But it's basically you take the market power strategies and they're done for you in your account automatically. So, um,
really quite exciting because this was just you think back a couple of years, just a thought, like someday we
yeah,
could,
it'd be really cool if this could happen.
yeah, it'd be really cool. It was just an idea.
But
And
we've talked
here we
about
are.
it. We talked
Yeah,
about it a long time ago, many
yeah.
times. It's like, man, like you do the Phoenix every day. It's tedious.
It's a
You
lot to
know, it's
it.
a money-making trade. Yes. It's profitable. Yes. All the ratios are good. We should do it. It's making money, but it's tedious, you
So,
know?
yeah.
And double dip, like, okay, you got to be there at the time when it goes off to put it on. And if you're not, you miss it for the day. It's like, oh, dang it, I missed it. So one of the biggest things that the market power members have been saying is like, yeah, I can't do all the trades. Well, now you can.
A
And
big, big thing. Big.
yeah, so we had so we had the system set up, and it was the biggest time it was a long problem because we didn't know if we could automate. We've never automated anything before. I've never automated a
Uh,
trade before. And to me, it's always like, I'm a trader. So I should be able to go into a trade and be able to fix it. And so almost all of our trades have some adjustment to it. There's like an adjustment method, and it's a manual adjustment method.
mhm.
You know, it's like we look at it like, what's the first question? If you're going to adjust, what's the first question? Well, how fast is the train coming at me? Right? If it's
A
coming at
lot
me
of little
really
factors.
fast, then you get out and you don't adjust. If it's coming slow, then you can adjust and then you can figure it out. But the computer doesn't know that. The computer can't answer that question, or can it? Huh. How would you answer that question if you were a computer? If you had to answer a computer, how would you answer that question? I don't know. Well, you got to figure that out. And then you got to play with all the different variations. And then you got to be like,
Mhm.
okay, this based on this, yes, it can be automated. So if the train is coming at you really fast, what does that mean? More than a 3% move in the last 60 days, which is higher than the average of the last 2 years, blah, blah, blah. I don't know. Maybe one way. I don't know. So it's like, it was really interesting how we were able to take the strategies that are manually done and try to rule base them to a point where a computer could just
Can do it.
step one, step two, step three, and it's not exactly the same as the way we trade them, but when we did all the testing on them, the results are still amazingly good. And so I know that like our manual trades, our official trades for Phoenix, for Double Dip, for Market Power, have done better than the autopilot trades. So we could look at it because we've done all the trades. We have all the history, right? It's the last 4 years of Market Power we've been trading it. So we know exactly how many trades did we have, how many wins, how many losses, how many adjusted trades. The Market Power that the system tested, back tested, had more adjustments. And so it made less money a little bit, but it also took more trades because there were some trades that we didn't feel comfortable.
Yeah, there's somewhere we did not. Yeah.
And we're like, oh, there's stuff going on. We're not going to take it. But the trade ended up fine. The computer didn't know that. The computer didn't know he wasn't supposed to take it. So he took it and it was fine. And
Yeah.
so, in that sense, it had more trades. So it made more money there, but it had more adjustments because it didn't, the rules are such so that it just has to adjust more. So I know that our results manually are better, but the fact that you can do more trades makes up for it, number one. And number two, the fact that you don't have to lift a finger, like I'll take less money.
No, I know, and I think it has the potential to improve, even get better
Yeah,
from where it
yeah,
is.
and we're
That's the
gonna keep
point.
playing with it.
Yeah,
Like
of course.
it's good enough now where the numbers are amazing, but it can still be improved.
That's exciting. Plain and
Mm-hmm.
simple. So
Yeah. So it's a new era.
yeah, we're part of it.
Mm-hmm.
So I'm excited.
It's exciting. It's interesting. It's exciting. It's interesting. I've had the trades going on in my account for a while now, and yeah,
I'll
it's
never forget
still.
the first day you told me like, oh, it just went off, and you had that feeling of like, I didn't touch it. I didn't do anything. It's like, oh, okay.
Yep, I still see it every day. It's like,
Yeah.
ching. I'm like, oh, what happened? Because I'll totally forget about it, and I'll be like, ching. I'm like, oh. And sometimes you don't know. It's like, oh, did I get out with a win? Did I get out with a stop loss? I don't know what happened. Ah, let me
Yeah,
check.
so every day you're like, huh, wonder what, gotta check my computer.
Mm-hmm. Yep. There was a trade, I think it was last week, and it got me out very close to the open, you know, and I don't know, I don't think I should tell you this, but like I wasn't even awake yet. It was 8:30. I slept late. I wasn't even awake yet, but the thing got me out and it was done, and I checked it. I was in bed. I was
That's all
awake.
right. I didn't miss the trade.
I think,
Didn't
yeah,
miss
you
it.
didn't miss it. You don't miss them. You don't miss. You were
I
on
don't miss
top,
those.
man. You're
Yeah.
on top. But yeah, so it was like I didn't even like I woke up after like I saw it after it was done, and I was like, oh, this is awesome.
I mean,
So,
that's quite amazing. Like it
mm,
can be.
so we'll have that tonight, 6 o'clock Central Time. It's a live presentation, and the fun part is going to be showing the results of the strategy. Um, Actually, there's different strategies. So it's like, how did the computer actually do? And one little tip is that, we did it from middle of 2022. So when, the zero DTE could really get started
Mhm.
to end of June. So it's, let's say 5 years, because you got half a year and then 3 years and then half a year. So 5 years. Every single of those years was profitable. So to me, that shows consistency.
Yeah,
You know, not every month was profitable, but most of them were. But every year was profitable in every single strategy.
that's what I always talk about. It's always like, okay, look, where are you at the end of the year?
Mm-hmm.
Never
Yeah,
just 1 month or
yeah.
1 week. Yeah,
So if you're not losing money, that means you're making money. That's a good thing.
yeah.
So, so yeah. So we'll have that tonight, and I'm excited for that. And 6 o'clock. If you're in the club, the link is in the club in the events tab. If you're in the Facebook group, we're posting the link there as well. If you're on the email list, you should have gotten a reminder There is no opt-in, no need to register or do anything. Just get the Zoom link and show up, and that's it. We're making it like super simple now.
Yep. So 6 Central.
Six Central, yes, sir.
Well,
Um, and people, the one concern people have, like, oh man, I hope I can afford it. I hope I can afford it. I'm like, yeah, you can afford it. I was like, yeah. I was like, even if you do like two more trades a month, which is nobody's doing every single trade, right? Because we have Phoenix every day that there's no market power. We have a surprise that happens every single day. And then we have market power go off like 6, 7 times a month. And then we got double dip, which happens like 9, 10 times a month. And there's
yeah,
nobody
sometimes
doing,
there's some very active weeks. It can be,
yeah, but nobody's doing all of those.
yeah.
And so if the thing only does like two extra trades, and sometimes depending on the strategy, it might just have to do one extra trade and it will pay for the entire year. So it's like, yeah, okay, it's not a lot.
Yeah, I mean, that's important for people to
with
understand.
with one contract.
Yeah.
So with one contract, it could make enough to pay for the entire year. So yeah, it's not a lot. So I'm cool. I'm happy with that. Yeah. Sweet. All right. So that's it for us. And
We're back on Friday.
I guess we should tell people to subscribe to the channel, right? We're trying to build our
Yes, please
subscribers.
subscribe.
So please subscribe. It's a brand new channel. We need some help there. And if you can like the video, comment on the video, say hi, do something. Thank you for those of us who are watching live and chatting with us. We like that. Um, and yeah, thank
That's
you.
right. Trade with the odds in your favor.
Trade with the odds in your favor. With that, we are